Gold at 8,900 United States dollars per ounce. Silver sprinting ahead. Mining stocks finally waking up and leaving the metal in the dust. Is that even realistic? Today we will break down Ronald-Peter Stöferle's framework from the In Gold We Trust research series and his two price scenarios for the rest of the decade. We will unpack why his team still sees a base case around 4,800 United States dollars per ounce by the year 2030, and, under persistent inflationary money supply growth, a path that stretches all the way to 8,900. Then we will show why silver and miners may be the surprise leaders in the next act. Stay to the end for a practical action plan and the biggest risks almost everyone ignores. If you believe that the gold bull market is over, consider this. Stöferle argues we are only in the middle innings of a long, secular upswing, what he calls the big long. His team's valuation model has not changed its long-term target since the pandemic era, $4,800 as a conservative end-of-decade estimate, with an inflationary pathway up to $8,900 if global money supply growth echoes the 1970s. The latest 2025 briefings and press materials from his research group reiterate both the base and the inflationary scenarios, and even flag a short-term downside air pocket to around $2,800 if trade tensions ease and risk appetite briefly returns. In other words, the road will be bumpy, but the destination may be much higher. Who is Ronald-Peter Stöferle and why his model matters? Ronald-Peter Stöferle is a portfolio manager and a co-author of the annual In Gold We Trust report published by Incrementum, an asset manager based in Liechtenstein. For nearly 2 decades, this report has been one of the most widely read deep dives on monetary regimes and precious metals. Stöferle and his co-author, Mark Valek, run a multi-factor gold valuation model that considers monetary dynamics, real interest rates, money supply trends, fiscal deficits, and investor positioning. Each year they publish a base case and scenario analysis that map out price paths to the end of the decade. In the 2025 cycle, they again articulate a base case of $4,800 by 2030, with an inflationary case that reaches $8,900 per ounce. Why does this model matter? Because it has been consistent. As early as 2020 and 2021, they publicly stated that if money supply growth resembled the 1970s, $8,900 by around 2030 would be conceivable. That thesis has been reiterated in subsequent updates, including the 2025 presentation deck. Consistency does not guarantee accuracy, but it does show a framework you can stress test as conditions change. The case for 8,900 United States dollars. Driver 1, structural money supply growth and fiscal dominance. The 8,900 figure is not a random moonshot. It emerges when you run a higher inflation regime through their model, one in which broad money supply grows faster and longer than consensus expects, often because governments run sustained fiscal deficits that central banks are reluctant to counter aggressively. If the next 5 years rhyme with the 1970s, think repeated cost shocks, ongoing geopolitical fragmentation, and periodic bursts of inflation, gold's role as a monetary hedge expands, and the model's upper scenario becomes plausible. Driver 2, central bank accumulation and deglobalization insurance. Another pillar in the framework is persistent gold accumulation by central banks. The exact tonnage can fluctuate year to year, but the direction has been strongly positive in recent years as monetary authorities seek insurance against currency, sanctions, and payment system risks. This creates a steady bid that dampens drawdowns and amplifies uplegs. Stöferle's 2025 discussions again emphasize that gold is at the center of a portfolio remonetization among sovereign players. Driver 3, the second phase of a secular bull market. Stöferle describes gold as being in the second phase of a long bull market, around the 6th inning. In this phase, public participation broadens, flows gradually increase into both physical and proxy vehicles, and narrative momentum strengthens. Importantly, it is still not mania. That leaves room for re-rating and multiple expansion, especially if economic growth slows while inflation remains sticky. Driver 4, scenario discipline, not certainty. The model is scenario-based. The base case remains $4,800 by 2030. The upside, under inflationary money supply growth, stretches to $8,900. They also explicitly warn about downside volatility, including a potential detour to roughly $2,800 if macro stress recedes for a time. This is not hopium, it is a map with forks. Segment 3. Why silver could outperform gold. If gold realizes those targets, why might silver do even better on a percentage basis? Stöferle often draws a distinction between safe haven gold and performance gold. Safe haven gold is the long-term monetary hedge. Performance gold is where investors seek torque: silver, miners, commodities, and sometimes even digital assets. Here is the silver logic. Point 1. The gold-silver ratio has room to mean revert. During fearful periods, the price of gold often holds up better than silver, pushing the ratio higher. As confidence returns and a bull market matures, capital moves down the risk curve toward assets with higher operational leverage. If the ratio compresses from elevated levels toward historical mid-cycle ranges, silver's percentage gains can exceed those of gold. Stöferle's 2025 commentary frames this as part of the catch-up potential in the performance segment of the trade. Point 2. Industrial demand tailwinds. Silver straddles monetary and industrial roles. Electrification, renewable energy build-outs, and data center power infrastructure all require silver at the margin. While substitution is always a possibility, silver's unique properties in conductivity and reflectivity make it stubbornly difficult to replace in many applications. If global reindustrialization and supply chain reshoring proceed, these tailwinds can add cyclical torque to silver's monetary bid. This is consistent with Stöferle's framing of silver as performance gold. Point 3. Under ownership and narrative lag. In mainstream portfolios, silver allocations remain tiny. That means incremental demand can move the market. Historically, once gold breaks to repeated new highs and captures headlines, the silver narrative follows with a lag, then runs faster. The 2025 cycle has already featured gold-breaking records. This is the classic setup for silver to pivot from under-owned to over-demanded in the next leg. Stöferle's recent interviews and event presentations reinforce that we are moving into a more participatory phase. Segment 4. Why mining equities could outperform the metals. Mining stocks are leveraged claims on the metals in the ground. When prices rise, cash flow can expand faster than the underlying commodity price because a portion of operating costs is fixed or slow-moving. Stöferle's team has highlighted several reasons miners may finally begin to outperform in this cycle. Reason 1. Operating leverage to rising realized prices. A sustained move from $3,000 to $4,000 per ounce has an outsized impact on margins for quality producers. Meanwhile, years of cost discipline and balance sheet repair, forced by the last decade's bear market, mean that many miners are better positioned for free cash flow conversion when the cycle turns. This catch-up potential is a recurring theme in recent Stöferle materials. Reason 2. Chronic underinvestment and slow project pipelines. Permitting is slower, environmental and social constraints are tighter, and capital expenditures have been cautious for years. New discoveries are harder and lead times are longer. This tightens the supply side just as the demand side is broadening in Stöferle's big long thesis. Fewer new mines plus higher realized prices equals expanding margins for incumbents. Reason 3. Valuation discounts. And skepticism, after a long period of underperformance, miners still trade at valuation discounts relative to their historical premiums during bull phases. When a sector is hated, modest good news can drive large re-ratings. Stöferle has said the market is barely in the sixth inning, implying there is re-rating room if the narrative shifts from capital destroyers to cash machines with dividends. Reason 4. Silver miners as the highest beta. If silver begins to lead, primary silver producers and high-quality developers can act like leveraged plays on both price and narrative. The caution is that the volatility is extreme, drawdowns can be brutal. That is why Stöferle repeatedly frames silver and miners as performance exposures, not core safety assets. Segment 5. The bear's rebuttal and how the model handles risk. A good thesis must survive good questions. Here are the tough ones. Question 1. What if inflation collapses and growth rebounds? In that case, real interest rates could rise and the opportunity cost of holding gold would increase. The Stöferle framework addresses this with the short-term downside scenario around $2,800 per ounce if trade tensions ease and risk appetite returns. In other words, the map includes exits and detours. Question 2. What if central banks stop buying? If official sector demand eased, it would remove a large stabilizing bid. However, the structural reasons for accumulation, reserve diversification, sanction risk, currency war hedging, are tied to long-term geopolitics. That is why Stöferle emphasizes the multi-year arc rather than month-to-month flows. Question 3. What if miners keep disappointing? Miners have earned their reputation for overspending at tops and cutting at bottoms. The difference now, according to the big long narrative, is that many balance sheets are better, new project pipelines are slower, and shareholder discipline is stronger. If this persists, while the gold price trends higher, the operating leverage argument remains intact. Question 4. What if the 8,900 path is just hopium? The 8,900 outcome is explicitly labeled a scenario tied to persistent inflationary money supply growth similar to the 1970s. It is not presented as the base case. The base case is $4,800 by 2030. That distinction matters. Segment 6. The timeline, how we could get there. Let us translate the model into a plausible sequence. 2025 to 2026. Gold consolidates at elevated levels with intermittent new highs as policymakers juggle growth slowdowns and price pressures. Periodic risk-on windows cause pullbacks, potentially as deep as the 2,800 area. Silver remains choppy but starts to outperform during upswings. Miners begin to show relative strength on good quarters. 2027 to 2028, fiscal dominance becomes clearer. Deficits prove sticky, global tensions keep supply chains tight, and money supply growth does not return to the pre-pandemic trend. Gold advances toward the 4,000 area on the base path. The gold-silver ratio compresses, silver gains faster on a percentage basis, and quality miners re-rate as free cash flow expands. 2029 to 2030. If inflationary money dynamics persist, psychology flips from temporary spike to enduring regime. The inflationary scenario path opens the gate to the upper bound near $8,900, while the base scenario anchors near $4,800. In that environment, silver and miners, as the performance tranche, could log the strongest percentage gains among the traditional precious metal exposures, albeit with heart-stopping volatility. Segment 7. What to watch? The 5 telltales. 1. Money supply and credit growth. If broad money resumes brisk growth and bank credit does not contract, the inflationary scenario stays alive. Stöferle explicitly links the 8,900 pathway to a persistent money supply impulse akin to the 1970s. 2. Real interest rates. Sustained positive real rates would slow gold's ascent. Negative or falling real rates are fuel. Track real yields against gold's trend. 3. Central bank purchases and policy messaging. Watch quarterly reports and policy speeches for signals that official sector diversification remains a priority. 4. Gold-silver ratio. A decisive multi-month decline in the ratio is a classic tell that the performance phase is underway and silver leadership is firming. 5. Mining sector free cash flow and capital discipline. Rising free cash flow, low net debt, and commitment to dividends and buybacks are the trifecta that re-rate miners. Stöferle's big long framework expects exactly that if prices trend higher. Segment 8. Strategy map. Building exposure without losing sleep. This is not financial advice, just a framework that aligns with Stöferle's safe haven versus performance distinction. Layer 1. Core safe haven gold. Start with a core position that you intend to hold through cycles. The purpose here is monetary insurance. It is not about outperformance, it is about resilience in an unstable world. Stöferle's work treats this as the foundation. Layer 2, performance silver. Add silver exposure for torque once gold strength is established and the gold-silver ratio starts to roll over. Expect higher volatility and be prepared for sharp drawdowns. Scale in on weakness during the base case path to $4,800, aiming to ride any compression in the ratio during the later innings. Layer 3, quality miners. Focus on producers with strong balance sheets, rising free cash flow at today's prices, and Tier 1 jurisdictions. If silver leadership is evident, keep a sleeve for primary silver producers with disciplined cost control. Expect the widest swings here. This is the performance gold sleeve. Risk controls. Set position sizes assuming a worst-case drawdown similar to that $2,800 air pocket Stöferle highlights as a possibility if macro tensions briefly ease. In other words, plan for turbulence even if you believe in the destination. Segment 9. Frequently asked pushbacks. Pushback. If gold goes to $8,900, the world must be falling apart. Why own miners then? Counterpoint. You own miners because cash flows can explode with higher realized prices, especially when costs lag. The world need not be collapsing. It may simply be deglobalizing and reflating. In that environment, gold rises and miners re-rate if they maintain capital discipline. Pushback. Silver always disappoints. Counterpoint. Silver disappoints until it does not. Then it catches up fast. In previous cycles, silver's leadership often arrived later, in the public participation phase, which Stöferle says we are moving toward now. Pushback. $8,900 is marketing. Counterpoint. The figure is clearly flagged as an inflationary scenario contingent on sustained money supply growth similar to the 1970s. The base case is $4,800. The model has published these two bookends for years, including 2020 and 2021, then reiterated in 2025. Segment 10, the narrative turns, public participation. The next act, if Stöferle is right, is broader public participation. Headlines normalize gold at new highs, while portfolio strategists who ignored the asset for a decade begin to formalize small target weights. Financial products proliferate. Silver's narrative wakes up as investors hunt for higher beta. High-quality miners begin to outrun the metal as free cash flow climbs and dividends grow. This is the part of the movie where the plot quickens. Stöferle's latest cycle calls this the big long, echoing the idea that the pendulum has further to swing than most expect. Segment 11. What could break the thesis? To keep this honest, here are the doom switches. A durable return to disinflation with robust growth and rising real rates. A credible, sustained fiscal consolidation in major economies that calms debt trajectories and reduces the need for monetary backstopping. A technological or regulatory shock that reduces industrial silver demand more than expected. A mining sector relapse into poor capital allocation at the first sign of higher prices. Stöferle's team acknowledges uncertainty by publishing a wide cone of outcomes and highlighting that short-term downside to around $2,800. The signal is not up only, it is higher with turbulence. Closing. So can gold really travel to 8,900 United States dollars in this decade? In Stöferle's inflationary scenario, yes, it is on the map. The base case remains $4,800. The more interesting twist, though, is that the leaders of the next leg may not be gold itself. If the past is any guide and the big long is still unfolding, silver and high-quality miners could be the places where the percentage gains outrun the metal at the cost of higher volatility. Build a plan that aligns with your temperament, use Stöferle's safe haven versus performance distinction, and respect the risk. The destination might be a lot higher than most investors dare to pencil in. If you found this video helpful, please give it a like, share it with friends and family, and subscribe for more deep dives into the hidden risks shaping our financial future. And in the comments, let me know, do you believe gold can really travel to 8,900 United States dollars in this decade? This is Felix. See you next time.